back to the Reagan RedZone. I'm your host, Webb Milward. Joining me today are my partners, Kevin Stipe and Harrison Brooks. Guys, good morning.
Morning,
Good
Webb.
morning, Webb.
Fellas, we are exactly at the midway point of the year, coming to you here in mid-July. For those listening, I hope you're having a wonderful summer. Hope you're tuning into the Red Zone in a beach chair or on a porch looking out over a lake. But hope everyone's having a wonderful summer. If you are on vacation, here's what you missed this week. The latest business insurance top 100 list came out earlier this week. For many of us, and I know for me particularly, the release of the list is sort of like Selection Sunday for March Madness. Everyone goes and looks at their name, looks at their position on the list. Have they moved up or down? But frankly, what's most interesting to me is the stories behind the rankings. And as I looked at the new rankings, what really struck me was so many of the top brokers, especially in that top 10 or 15, are in a state of transition, right? If you think about it, they are digesting and integrating large acquisitions. They're working on a significant change to their capital structure. Overall, look, they're consumed by integration, capital events, and overall kind of complex transformation initiatives, right? What does that look like? It looks like technology and AI adoption, talent movement, and trying to continue to build out their teams. Frankly, driving growth through a soft market for the first time in almost a decade and the pressure around revenue. And then, as Harrison will talk about in a minute, kind of investor scrutiny and the markets, reflected in kind of the ups and downs of public valuations and stock volatility over the last 6 months. So there's a lot going on and a lot to talk about here, guys. Excited for this conversation. But as I tee up Harrison, look, this isn't just a public broker story, right? There are always implications for privately held firms, whether it's through recruiting, their own valuations, client expectations, how they think about growth strategies, and overall their competitive positioning in the market. So with that set up, we'll dive in. Harrison, when you think about public brokers right now, you think about what's going on at the top end of the market, what stands out to you the most?
Yeah, I think the outlook is a little murky, Webb. I don't think we really know where we head. I mean, I've been at Reagan now for 11 years, and pretty much all of those time period, we've been in a hard market. So I've never seen a soft market, right? And so how long are we going to stay in it, and what pressure does that have on valuations? Not to mention the threat of AI, which caused, back in February, Black Monday, when the public broker stocks dropped around 10% overnight because of a man and a dog and an app with the threat of AI disruption. I think you could chalk that up to Wall Street not really understanding our business in its entirety. So to put that in context, right? I mean, if you look back where the public brokers were earlier this year, we were down to valuations we've not seen in a while, like 12 times a broker's profit, 12 times EBITDA for valuations. Put that in context from where we were in 2024, just 2 years ago, we were approaching 19 times EBITDA for brokers, right? So in 2024, 19 times EBITDA. So the spread over 2 years from 19 to 2 is significant. And largely what happened, why was that the case? It was growth expectations being reset, right? These public brokers are valued based on their projected earnings. And if we're looking down the barrel of a soft market for the next 3, 5+ years, that has implications to how folks value brokers. So then all eyes are on brokers this year in terms of where public valuations go, because most of the private firms benchmark themselves against the public brokers. Well, interestingly, since even you look over the past month to month and a half, we've seen over the summertime, while people have been on vacation, we've seen a bounce back in the public broker stock price. We're up to over basically 13 times EBITDA. So we're down to 12. Now we're up to 13. You put that in context to 19, we still got a long ways to go, but that's in a period of a month. That's how quickly things can change. So that's interesting, right? As you think about the public brokers, the largest firms in the world are valued lower than, call it, firms between 50 to number 100 on the list. So the private brokers have not necessarily reset their valuation expectations or their internal values, and they're still keeping those higher, believing that this is not a sustained period of where valuations sit. So I think this era where we sit right now is the era of opportunity for the private brokers to lean in and use their stock as a weapon to go out and compete in the marketplace, whether that's for acquiring a firm, recruiting talent, et cetera. So how long will we stay and kind of suppress what feels like suppressed valuations? I don't know, but I think the soft market will be the biggest indicator of that. So that's an encouraging thing is we're seeing the, pressure on valuations causes a lot of issues with firms in terms of operationally capital structure, the ability to repay debt, to do acquisitions. And so just this bounce back in the past month is very encouraging to me because I don't think the outlook necessarily has changed too much on how long we're going to be in a soft market. So that's my initial takeaway when we think about the valuation landscape.
Yeah,
Well,
Kevin.
I'll just jump in here. A couple things. One, Webb, the fact that you equate the release of the BI Top 100 list with March Madness is I find that really sad. Okay,
Yeah, it's a nerd alert, Kevin. It's
that
a
is
nerd alert, but we'll
that's
still
brutal.
love it. It's
And
okay.
Harrison, welcome back from your summering in the French Riviera. It's nice to have you back in the office after your little detour through Southern Europe. So great to have you guys.
We'll edit this out later, Harrison. Don't worry.
Yeah, we'll edit it out because I think it's to let the record state Kevin was there 2 weeks prior, but that's fine.
We'll edit out Harrison trying to argue why a 5% bounce in the public broker valuations is somehow highly encouraging. We've got a long way to go. And you know the old expression about even if you drop a dead cat far enough, even it will bounce. So look, we got to see what happens with the public broker valuations. I don't think we should obsess too much over the monthly ups and downs of what's going on in the stock market. I think a more foundational look at how these guys are doing is always helpful. But look, better that they're up than they're down further. I think we're all grateful for that. And it is interesting to see what happens to their stock price month to month. But I think there's a bigger case here to be made for what's going to be happening in M&A over the next 5 years with these valuations where they are. I think what's going to happen is brokers, both publicly traded and privately held, are going to continue to watch this and see whether a repricing emerges for the public brokers. If so, then we're going to have to see valuations come down. We are not seeing that yet, even in processes that we've been involved in this year. We've got firms that are consistently bidding on stuff that they want to buy above their own valuation. And theoretically, you shouldn't be allowed to do that, but that's what's happening. And I think that's the biggest signal I can see that there is a level of confidence that this is very temporary, that those deals won't be dilutive when looked back on a year or two from now. And I think that's a sign of optimism being expressed by those that are pricing deals more aggressively, that this is kind of an anomaly and they'll look back on it and it'll just be kind of a short era. Certainly.
And Kevin, take that even to the other era of firms that are public saying, we're going to do share repurchases. Like this is our company's on sale right now. If I'm a public broker trading at these levels and they're taking on debt to buy their stock back and go to the extreme of that and even say there are public brokers that are listed right now. If you read the press rags, I mean, that they're seriously considering going private. I mean, so it's saying that we're not putting up with where the public markets sit. They don't fundamentally understand all of the assets beneath our business, right? So these larger brokers that are publicly traded, they're diversified portfolio companies. It's not just retail brokerage. It's not just personal lines. I mean, it's MGAs, it's MGUs, there's wholesale divisions, there's retail brokers. Like this is a diversified platform that has the ability for a lot of these to think about vertical integration and leveraging technology. And so
vertical integration, huh? Is that
vertical integration?
Is that a little buzzword you're going to drop on us here?
Little buzzword, but it's a real thing, Kevin. It's, welcome to the new era. Welcome to the new era, Kevin. But I think there's a ton of opportunity there where, firms that are thinking about actually integrating their business, pushing product across the platform, like they're not going to put up with these valuation levels in the public markets. They'll go private because we've not seen the private markets correct. And like you said, public brokers are paying more than they're trading. Like they're paying more than what they're actually valued at. And so that's a good indicator of, I think where we're headed from a valuation perspective, especially if you're a privately held client, if you're a privately held firm out there, that gives you some good peace of mind from, you probably have a lot of your net worth tied up in your agency, and we're not seeing this erosion of value in the marketplace.
Well, Webb, you look at the top 100 list, and it's always July when it comes out, and yeah, it's intriguing to see kind of what's going on at the top and the bottom. I was kind of moved this year by a sense that there was very little that actually changed in terms of the top end of the list itself. I think out of the top last year's top 20, there were only two changes, and that was Assured Partners and Risk Strategies. Both were acquired by Gallagher and Brown and Brown. Outside of that, it's a pretty static. You've got little moves here and there, but it was actually a pretty static thing. And I think your observation that if you look into those firms, there is a lot going on in terms of internal initiatives that would suggest that even though the list itself isn't moving around that much, we are in a moment of stress, and we're in a moment where I think 5 years from now, those that really strategically figure out what are the necessary foundational growth strategies are the ones that are going to win. And folks that get distracted by shiny objects and move in the wrong direction are going to be left behind. And I think what is incumbent upon us as a firm and industry observers is to figure out what are those essential things that people really need to be focused on during a time of stress like this.
Yeah, and Kevin, I think where my head goes is, you know, look at number 100 on the list. I think that's always interesting to see, like, how did that shrink, increase, or decrease from a revenue perspective. And if you look last year, I mean, we're up the number 100 firm over $3 million in revenue. So there's this whole storyline, right? Last year, like hyper
30, you mean,
consolidation in
right?
the industry.
You said
The
30,
yeah,
30. Yeah.
yeah, 31 million is number 100 this year, where it was 28 last year. And so, and if you look down that list, I mean, there's a lot of firms that are new that have popped up on the top 100 list. And so I look at number 100 increasing by $3 million, even in the face of continued acquisitions that are happening in the market. And that firm, interestingly, is Benny Health. It's a benefits broker. I mean, Matt Straz and Brett Davis, those guys started that business 7 years ago. 7. And they're number 100 now. All benefits. And they've done it all organically. No acquisitions. Like, that's amazing. And the tech stack that they have, they're building a new age brokerage. Like, that's encouraging when we think about our distribution model in terms of insurance distribution. It's powered by people, fueled by technology. But like in 7 years, we have a new top 100 broker that's basically been born that's just benefits. So that is interesting and inspiring to me. Of you there's a storyline of, last year, a year prior, this consolidation. Can firms really rebuild? Can they regenerate? And the answer is yes. Will they do that at the rate of consolidation? Probably not a 1-to-1, but it's happening and the numbers are showing it. So we're actually moving in the other direction. So I think it'll be interesting to see, where we head there.
Well, it's always interesting to see that you've got firms on this list that are well over 100 years old, and then you point out one that was originated 7 years ago and has vaulted its way onto this list. That's an impressive feat. I'll tell you what. I'm going to shift gears a little bit here. One of the things that I notice going on in the top 100 and then more broadly throughout the industry, and it doesn't matter what capital structure you have, this applies to the public brokers, the private equity backed brokers, the pure independent brokers on this list, is how many firms are going through or entering into a next generation leadership change. And running into some interesting headwinds, and I'm going to ask you guys to check this. I'm the old one of the bunch here, and so I want
That's
to be
true. You
real
are. I
cautious
can confirm. Yes.
about too much generational commentary. But what I see going on across a lot of clients and then firms that I'm just even reading about is that there are leadership transitions that are being made, and what firms are finding, and this is going to be a little bit more anecdotal now, but what firms are finding is that they don't have a deep bench of potential leaders to step up and drive the firm forward. And in fact, in certain cases, they're going to the most capable potential next generation leaders and having conversations with those folks where they're saying, I'm not sure that's really what I want to do. I like the job I'm in right now, and I might just want to stay in my lane. And it's like, oh my gosh, this is the opportunity to lead our organization from our historical position to kind of that next level. And when somebody's offered that opportunity, they're turning it down. And if this was just one or two situations I was seeing this, I would probably wouldn't register. I'm seeing this in a lot of different situations. And it's just making me wonder if we've got a generational difference. I guess it'd be easy to kind of say it's the millennial era right now where that group, just age wise, is the one that is kind of the next gen to lead. And Harrison, you being a millennial, I know you get really defensive around this, but I'm going to ask you to kind of explain the psychology of your generation. Do you agree first that we're seeing less millennials, maybe proportionate to prior generations, aspiring to take on really elevated leadership roles first? And then if you agree or disagree, go ahead and explain yourself.
I think I agree. I hate to say that I agree with you, Kevin, but I think I do agree. And I'll tell you why, especially in insurance brokerage. I think that we have to be specific on our industry. If you look at the highest income earners across our clients or in an insurance broker, it's a producer. Full stop, it's a producer from a cash W-2 perspective. And I think millennials value cash W-2 over long-term wealth creation in terms of instant gratification. So you're a producer, you get to build client relationships, have fun doing that. The world is moving extremely fast, like with AI and soft market and the things that you have to do as a leader to navigate that, to protect your people. People are trying to poach your talent. That doesn't sound that fun. Like to step up and lead $100+ million shop or a $30 million organization. The returns and the wealth creation are enormous, but it comes at a sacrifice. And I think a lot of folks are saying, I'm going to stay in my lane. I'm going to be a producer. That seems like a great work-life balance. And these are relational individuals, right? And so you're asking them to step up and to run a business, many of which are fueled by institutional capital, which has extremely strong demands on financial returns and quarter to quarter performance. And so I think there are some that are stepping into the moment. I can think of clients and CEOs that are saying, hey, I'm going to come to a roundtable discussion. I'm going to get up at 4 a.m., fly across the country to go to a technology AI conference to learn about how to make my firm better. I'm going to fly back to the middle part of the country, and I'm going to work on my employment agreements and put in place a synthetic equity plan. I'm going to have coffee with 4 producers this week. They're doing the work. And there are some that are doing that. They're meeting with firms to potentially merge with or acquire. But that's hard. And that's not what everyone signed up for. And I just think that's what we're feeling right now in terms of and these firms are larger now. They're more complex. It's not something that you can just jump into. I mean, I think, and we're facing a new era that no one's really seen over the past, 9 years in the soft market. So that's my initial reaction to it. So
Well, what do
Yeah.
you do planning with a whole bunch of really high quality firms around the country, and this is obviously something that when the door gets closed and you're with a board or a leadership team, this is like issue number one. What do you see?
Yeah, I have a slightly different perspective. I don't think the issue is as much an unwillingness to lead. I think the more interesting question, and you talked about strategic planning, is whether firms are creating the conditions for the next generation to succeed, whether or not they have an active succession mindset. Are they actually viewing leadership succession as a strategic priority? Or is it like the last thing the older CEO does before they close the door and walk out? And for a lot of firms, I'm seeing, Harrison mentioned kind of this next man up idea. We have a lot of clients right now where that next generation is pushing their way through that door. They're running towards this opportunity and the great responsibility that comes with it. And what we're seeing is as you're to your point, leadership demographics are changing pretty fast. I think the new generation of leaders has influence. They tend to have a pretty high tolerance for risk, right? They're moving with a lot of speed. In some cases, they've got a lot of autonomy. And you think about just the soft market right now, they're going to have to pursue new growth strategies. They're going to do the firm's first acquisition in its history. They're going to do the firm's first lift out in its history. They're going to look to geographically expand to a market that might have made no sense 10 years ago, but for some reason, there's talent, there's an opportunity, and they're going to go into that new market. And so I'm actually very excited and bullish about what I think are my peers, and I'm kind of generationally right in between you two. A lot of my peers that I see really taking the reins and having a lot of success. Now, why is this important to me? I think, or why is this important for the industry, excuse me, is the question is, are they uniquely equipped to navigate these challenges? Is someone Harrison's age, for example, better equipped to navigate AI and technology transformation than someone in your generation? Maybe yes, maybe no, right? You could still have an older person who's really savvy with technology,
Thank you.
but someone, what's that?
I said thank you. That was
Yeah, but someone in Harrison's age, right, has had technology as a part of their whole life. And so they're, as people would say, they're digital natives, right? The other thing I would point to is talent and just the ability to attract your peers and other millennials to your organization to come along with the vision that you have to really spur growth for the firm. So I actually, with that, I get pretty excited about where we are. Not to say there's not a lot of problems and a lot of firms that are having serious challenges with their leadership transitions right now, but I do think there's a lot of folks being successful with this.
Well, it's always funny to me. People, these firms, these staunchly independent firms end up selling. We've all had this happen in the communities all over the country. You'll have the beacon of independence in a particular state will suddenly and inexplicably sell. And a lot of the peer agencies in that part of the world will look at it and say, "Oh my gosh, they chased the money. That was a money grab. They couldn't resist the temptation." And in reality, as an advisor to firms that end up remaining independent or in some cases do something with a third party, I'll tell you, I've seen a lot of firms sell over the years, and the little secret behind the story in many, many cases is that there was not enough appetite and or perceived capability among the next generation leadership for that firm collectively to say, we want to stay independent. And so what ends up happening is that they're not with a mindset of going out and chasing the money as much as the shareholder group is getting a consolation prize of a lot of money in the most recent era for having to face up to a failure of being able to really develop a next generation of leaders that everybody could look at and say, yes, we're confident in their ability to take us forward.
And I
And I
think,
think that Kevin, that starts with, I mean, I was with a large privately held firm this past week, and with 5 folks on their executive team, 3 of them started as interns. Like, that's the work we have to be doing right now. I mean, that's the work we're doing at our company is I think in a world that's like, you look at like Meta laying off a bunch of people, right? And for the past 10 years, we've heard millennials change jobs every 2 years. Like, I think people are tired of that. They're looking for a home with a good culture, to be part of the team, to be part of a work family, to have a sense of belonging and a place to have fun, to come alongside of your colleagues, to go pick a fight in the industry with a team that's going to have your back, that's going to invest in you. Because they're isolated, They don't have that camaraderie. You build that environment and you welcome them into that and you give them the tools with technology. But like that's a 10, 15-year process of internships, mentoring, deliberate training programs, elevating. Hey, it is admirable to not just be a producer and care about yourself, but to build the firm. And here's how you steward it for others. And so that's a very deliberate process. And so I think that's the biggest thing. So it's not AI, it's not the soft market. It's, are we planting the seeds today over the next 5, 10, 15 years to give enough folks the opportunity to step into leadership? Because they can't just, I mean, it's intimidating. I mean, it's just intimidating if you're in your mid 30s to be like, okay, now you're kind of the next guy up. Let's see if you can do it. It's like, yeah, it's
Well,
there's
I think another positive trend emerging here is a bit more of a team approach to leadership. I think about some of our clients, they're having a lot of really honest conversations in their boardrooms about skill sets, personalities. It's not just the biggest producer is now the CEO or the family member is now the CEO. They're making some tough decisions to really align the right talent, to meet the complexity of today's industry. And I think that team approach is really cool and obviously a sound strategy as you think about all the things that you mentioned, all the things these firms have to navigate. I'm seeing a lot of really positive movement on that sort of
Well,
team piece.
Webb, it's funny that you say that because we've got a lot of clients that have really good leaders today that have been leading for 10, 15, 20 years. And the role that they stepped into was maybe leading 25 people. And now their organization is, 300 people. And it's like, and the mistake that they make is they say, okay, well, we've got to replace so and so who's retiring, and they look for the person who's 40 years old to replace that. And it's like, whoa, 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 wait a minute. That person grew up with all kinds of tough lessons, and they grew into this role. And now you've got a role that's far more complex than it was when they started doing it 15 to 20 years ago. You don't need to find a replacement for that person. You need to break down what it is they're doing and maybe address that with a team of 3 different people, all who bring some key strengths that can cover aspects of that. So I think that people are, if you think about a leadership succession issue as replacing a person, as opposed to reassessing what your leadership needs are, breaking those down, and then seeing how you can approach it with a team, I think that's a much more sensible way to think about leadership success.
So
I think
so
it's
then in that sense, what are those strengths you think in what firms should be looking for a future leader? What are some of those key attributes? You have
two come to mind, Webb, for me. Two biggest ones: agility and authenticity. I think it's right now. You look at some firms, and it's a revolving door of who gets to be CEO. CEO, next man up, and they bring him in from another firm, or they jump over. I'm not sure that those individuals some can. I'm not sure those individuals can garner the respect of the organization, and then agility from just the pace at which business is moving right now, and just the ability to make calls and just flexibility to change direction of the firm based on what's happening in the market. Those, to me, agility and authenticity are the two most important things.
Kevin.
Yeah, I mean, if the question is how to identify in your next generation who is truly an emerging leader, and not just saying, okay, the most aggressive person, the person that's got the biggest book or whatever, is, I don't think many firms actually think about it that way. But I would say, number one, look for people who others listen to, who may have no authority in their role or title whatsoever, but look around and see who is naturally being listened to by their peers. That's kind of early sign leadership.
Influential.
Yeah, yeah, absolutely. And then the other that I would throw out would be conflict, the ability to constructively deal with conflict. And there's two attributes to that. One is, do they run away from conflict? You can't have a leader who is so conflict avoiding that they won't deal with issues as they come up. But then You want somebody who constructively deals with it, who can go in and put a fire out as opposed to pour gasoline on it and create more problems. So I would say those are the two things that I would look for.
Yeah, I think I'll play here. I think the one I would add, maybe you haven't touched on, is talent magnetism. So the ability to really attract and recruit talent, the ability to then retain that talent, bring them into your vision for the firm, create that sense of kind of loyalty and also excitement or enthusiasm for what you're all going to achieve together. I think some of my favorite CEOs in our industry have this magnetism to them where even we leave a meeting, right? And we are like, God, I'd work for that person tomorrow. You get really excited about what they're doing. And so, given the talent movement out there right now, I think the ability to, as you said, influence, but also be kind of a magnet for your firm, I think is really critical. So we're a little over time. I'm going to turn our 2-minute drill into a 1-minute drill, and we're going to bring this home. Back to the privately held firm. What is one thing that excites you guys right now for a privately held firm? If you were running a privately held agency, what are you excited about, you think?
I'm going to let Harrison go first with his whatever shiny object he's fired up about now, and then I'm going to bring it back to the foundational basics. So you go ahead, Harrison.
Yeah, I really appreciate that. That's great. Well, I think right now in the market, I think there's a massive opportunity for accounts that are $5,000 and lower in commissions or personal lines accounts. We call small commercial or lower middle market and personal lines. A lot of institutional investors are moving away. They're outsourcing those business segments and they're not servicing those and they're harvesting profit margins. I think in the short term, it's a good strategy. I think as we look at privately held firms building long-term value, those small clients can turn into massive clients. And I think technology allows us to do that in-house, to do that better than we've ever done it, and to really serve our communities and our clients really well. Not all firms are positioned or have the infrastructure to do that, but that's where the market opportunity is now. When you look at 30,000 plus agents and brokers in the marketplace that are around that have a lot of that makeup in business, if you can figure out how to crack that code, there's a lot of value there.
Great. Kevin?
I'm going to say right now, with all the distractions and all the AI stuff, focus on your core. And by that, I mean, do not underinvest in your next generation of producers. We developed a new benchmark in this year's best practices study. It's called producer hiring velocity. We now have the numbers across the best practices firms. It's a very simple metric. How many producers are you hiring this year, divided by the number of total producers, both validated and unvalidated, that you started the year with. And the number, drum roll, the number is 15. Do not hire less than 15% of your existing production force this year. If AI is going to save you money, redeploy that money into hiring that next generation group of producers. They are your ticket to future independence. If that's what you truly value, make sure you've got a strong core.
Yeah, and I'll piggyback on that for the thing I'm excited about is just the ability to recruit high impact talent. I think that there's just so much opportunity if you have your recruiting muscle and your recruiting strategy in place, the ability to add really high impact talent to your firm who can immediately come in and drive revenue, build out an initiative, whatever it is. I just think there's an exciting environment for that right now. So with that as a close, I'll just offer that, periods of transition like this do create uncertainty, but they also create a lot of opportunity. And I think we're all pretty bullish on where the industry is headed and appreciate all of you all tuning in today. Have a great July and we'll talk to you again soon. Thanks, guys.
All
Thanks,
right.
Webb.
Thanks, guys. See you.